Almost everyone who thinks they own gold doesn't. Roughly 98% of gold investors are holding paper claims, not physical metal, and that's fine, until it isn't. In today's Block Bites, Tommy will break down why that hidden risk matters, how it mirrors problems we've already seen in crypto, and what it means for real ownership in the next market shock. Let's get into it.
Hey guys, it's Tommy here, and I am going to break down today's article. According to recent analysis, roughly 98% of investors who say they own gold don't actually hold physical gold bars. Instead, they own ETFs, futures, certificates, or other paper-based instruments that track gold's price, not the metal itself. Most people think owning gold means holding a physical bar in your hands, but that's not true, and it could shake the way we think about safe haven assets. When you buy these paper gold products, your exposure depends on a provider or institution. In a crisis, those promises might not hold, and investors could find themselves holding just contracts, not actual bullion. In normal markets, this structure works fine, but during periods of stress, liquidity crunches, bank failures, or market halts, claims can be delayed, restricted, or settled in cash instead of physical delivery. That's when the gap between price exposure and real ownership shows up. This isn't theoretical. Financial history shows that when markets crash, indirect ownership can fail you. Think back to 2008, and more recently, AFTX in crypto, where reliance on third parties left people unable to access what they thought they owned. Holding assets on exchanges or custodial wallets can mean you don't actually control your coins. Just like paper gold owners don't control real bullion. This doesn't mean paper gold is bad. It means investors should understand what they actually own. Whether it's gold, stocks, or crypto, exposure gives you price movement. Ownership gives you control, and those aren't the same thing. In calm markets, the difference feels irrelevant, but in stressed markets, it's critical. The key lesson is to be aware of counterparty risk. Counterparty risk means that if a provider fails, goes bankrupt, or restricts access, you might not actually have the gold you think you own. In normal markets, this usually isn't a problem, but during crises, like liquidity shortages, bank failures, or market halts, indirect ownership can fail when you need it most. The same principle applies to crypto. If you rely on exchanges or custodial wallets, you might not fully control your coins. Remember, not your keys, not your crypto. Understanding the difference between exposure and ownership helps investors make smarter decisions about risk and control. To reduce counterparty risk in crypto, you can store assets in self-custody wallets rather than on exchanges. Use hardware wallets for long-term holdings. Keep only what you need for trading on exchanges. Consider multi-signature wallets for added security. Always verify providers and avoid over-reliance on a single platform.
Thanks so much, Tommy, for breaking that down. If you found this helpful, don't forget to like, subscribe, and hit the notification bell so you never miss our crypto insights here on Block Bites. Have you ever experienced counterparty risk in crypto? Tell us your story in the comments. See you in the next update.